Hi, this is Jeff Fien at Retirement Calculator Headquarters. Today we're going to go over a retirement planning model, meaning that you're withdrawing funds periodically from an invested source. We're going to build a very simple model at first that we'll improve on in later installments of this video series. First we need to decide on a beginning balance, a withdrawal amount, and a rate of return. These numbers are not selected for any particular reason, but let's just choose $1 million for the beginning balance and $80,000 annually for the withdrawal amount. For the return, let's assume 5%. The formula that we'll use is simply the beginning balance minus the withdrawal, in parentheses, multiplied by the growth rate, which is 1 plus the rate of return of the investment. Now we'll drag these formulas down so that we have a row of data for each year that the withdrawal occurs. Doing this, we can see that it's lasted into the 19th year based on these numbers. Of course, in this scenario, that's shaving it rather close. I would certainly want to see more money available to draw upon in my 19th year of retirement. So, to address this, let's assume that our hypothetical retiree decides to invest more aggressively in order to generate greater returns, and hopefully this will lead to a longer retirement income. So he decides to invest in a stock fund, which is averaging 7.5%. If we use that average, we'll see that by the 19th year we've only eaten through about half of our starting figure of $1 million. However, we should keep in mind that we haven't built any volatility into this scenario. And although with the stock fund you may average 7.5% per year, your returns on a year-by-year basis are liable to be much greater or much less than this average. We can see the possible detrimental effects of this if we just assume a negative 10% return the first 2 years of the retirement income stream, in which case the income will only last into the 15th year. In a later installment, we are going to build a model that generates random returns that mimic the behavior of our stock fund for each year of the income model. This model could be used for any volatile investment. It doesn't just have to be a stock fund. Also, this very simple model is not taking into account inflation, so we'll address that as well. After that, we'll build a comparable model to contrast this withdrawal model with an annuity income. We will address these issues and more as we continue expanding on this model. Thank you, and don't forget to visit Retirement Calculator Headquarters. Thank you.